Okay, welcome back, everybody. So here we are on day 5 of the pullback course, and we're going to talk about two things that are really the same thing, or flip side of the same coin, maybe. We're going to look at what happens after a pullback forms, and we're going to lay out some scenarios. I'll show you the way that I think about it, and you can adapt that for your own use. And then we're going to talk about trade management, and obviously the that's dealing with what happens after a pullback happens. And I think that there's a truth here that if so many of the psychological struggles that people have in the market can happen for a lot of reasons, but many of the common problems come from, let's say, unrealistic expectations or not understanding how the market, so we say the market is probability based, but when it comes down to actually trading, a lot of times when we put on a trade, we think we know what's going to happen. So the magic, if there is any, of this trade management approach is that it really forces you to interact with the market in a way that respects the reality of the market. If you think back to day one of the first things we did, I spent a good deal of time talking about the unpredictability of the market, talking about the randomness or the noise in the market. And what you will see here today is a trade management approach that not only respects that, but operationalizes it, puts it into practice in the market. So the idea that you need to keep in mind is that basically, this comes, I think, first place it was in print was in that Mark Douglas book, where he said that anything can happen in the market at any time. And that is within the range of price limits. There are daily trading limits on things. They will at some point shut markets down. But even that, if so you might think, okay, Adam, well, it's not that anything is possible because there's a price limit. But what if something happened where the market made a big move to a price limit and they shut the market down, and then they opened the market again the next day and it went to the price limit again? You could imagine a cascade where effectively you would have this kind of gigantic move that, even though it might not be able to play out in an instant, you might not be able to take action, and it might effectively be the same thing as you being locked in. Could you imagine major global stock markets effectively being locked limit? For those of you who've traded futures, you understand the concept of locked limit and what that means. For those of you who haven't been there, it used to happen a lot more, happens less now for various reasons, but you would have a market, for instance, it might be going up, and if you're short, you simply cannot get out. Because it might go up day after day after day with a very large price move. It might just open at the price limit and not even really trade there. Some days only trade a handful of contracts. And of course, you can offset things in the options market, but you pay for volatility, issues like that. And that sort of thing could even happen in stocks. Now, that's the possibility. The possibility is there. The probability of that happening is vanishingly small. But if you interact with the market in any way, it is, and this is something that most trading courses aren't going to tell you, it is worth thinking about these crazy extreme scenarios, because if you do this long enough, you're going to see things that you just don't even think are possible. You would not, what you don't want to have happen is to have something come into the market, to have a price movement happen that is so far outside of your experience that you can't even process it, you can't act. That's how we get in trouble. So we do want to make sure, psychologically, is how we get in trouble. And I've told stories in the past about, I worked with a trader one time who we were in person, and he knew he had to get out of the trade. And I was watching his hand. It's the most fascinating thing I've ever seen. Close. He literally could not make his finger move to get out of the trade. He was talking to his hand. He just couldn't do it. So, the brain is kind of a weird thing sometimes. And the best way to protect yourself against that is to get in the mind frame and the habit of really thinking about all of the possibilities of the way the market can unfold. So, because we don't deal well with infinite possibility, it's definitely worth our time to collapse price action into possibilities. And when we do this, any model. One of my favorite models, which I mentioned here, is the idea of thinking, okay, sideways, up, down, and then really big up and really big down. So you just kind of collapse it into 5 possibilities, but we're going to do this today with other possibilities after and around pullbacks. Just remember, what we're doing here is really creating a model price action. We can have a whole course on models. A model is just a way that we look at reality. It's not the thing we're looking at, because the thing we're looking at is so complicated or has so many parts that we can't wrap our heads around it. So what we do is we simplify it down, and we say that if that's kind of the essence. A model is a simplification, and we say, okay, this represents the thing enough that we can talk about it like this. And models can be good or bad depending on how good the assumptions are. So here's the model that I want you to think about, at least for today, for post pullback action. So what happens after a pullback? And there are, broadly speaking, 2 possibilities. One is the pullback works. The other is the pullback fails. End of course, right? No. And you're thinking, okay, that's not particularly brilliant. Either it works or it doesn't, but it's how it works and how it doesn't that is what really matters here. And we will look at 3 possibilities for each. So if the pullback works, the obvious way the pullback works is the thing just explodes and just keeps going, right? There are also several other smaller outcomes. And if the pullback doesn't work, what you might imagine is, say you're buying a bull flags, the market goes up and comes back a little bit, and you buy it and it absolutely collapses. That's a pretty obvious failure. But there are also other kinds of failures, and let's dig into those. So probably the smallest requirement for success is saying that you get to the previous pivot. What do I mean by previous pivot? I'll draw bars here, but we could just do swings or candles. So you have a market that's doing its market thing, and it goes up and it rolls into a pullback. Okay, so there's your bull flag. This is the previous pivot. So all we are saying is that you get back to that previous high. We're not saying you go beyond it. We're not saying it extends into another swing. Just that we touch just that we touch that previous high, or conversely flip it, the previous low. So that is really kind of a low bar for success. One thing that you do need to be aware of, depending where you get in here, and let's draw this out. We'll do a little bit more of this. So let's say that you're buying above this pivot and your stop is here. Maybe it's a little bit of a wide stop, but let's just say you did that. Look at where your 1-hour target is. Your 1-hour target is above this pivot. I'm going to tell you the same things today from several different angles. We'll certainly see this again. So do be aware that just because you got to back to that previous pivot, that does not mean that you got your 1-hour profit target. This is a particularly, if you're thinking, pullbacks are hard to test. It's very hard to craft a quantitative test of pullbacks that is anything like what we would trade in the market, because we like to keep tests as with as few moving parts as possible, but we also want to represent what we would see. And pullbacks, there's a lot of moving pieces. So if you want to figure out how to structure a pullback test to say if a pullback works or if a pullback doesn't, you can use this simple criterion of getting back to the previous swing. If you do that, you'll find it's certainly easy to set up tests of pullbacks where you see like a 66% success rate or something like that. That's possible. I will also tell you that this, even though this seems like a really low bar, just getting back to a previous pivot, again, your profit can be 0.3, 0.4 R potentially. That is a useful point for intraday traders. When I was trading the S&P very actively intraday, this was one of my exit points. I would many times just buy a pullback, and I would get out of the whole thing if we could get back within a tick of that previous pivot. So this is not just theory. This is not something that we have really put into operation very much on daily charts for swing traders, but it's worth looking at. It certainly is a viable concept. And the other thing to realize about this is that these previous pivots are something that everybody can see in the market. So what we do tend to see, look at the end of my arrows here, and what I've done is just carried forward the previous pivots. almost always you see some price action here. Now, this is kind of a weird market that many of you will never trade and maybe not even know it exists, but this is soybean meal. You pull soybeans out of the field. You know how you take crude oil and you put it in a refinery and the crude oil molecule is cracked open? That's why you talk about the crack spread, and you get a bunch of things from it, but pretty much the things that we price as traders, we look at the price of crude oil, and then we look at heating oil, and RBOB gasoline, and is the distillates. There's a lot more stuff that comes from comes from crude oil distillation. You have a similar process with soybeans, actually, but it's called the crush. So you're talking about the crush spread, where you take the bean and you crush it, you squeeze the oil out, and then you're left with the bean meal. So it's a little trivia that might or might not be interesting. But I will tell you, if you don't trade these agricultural markets, they do feel, we talked about this a little bit too, right? They do feel quite a bit different than many other markets. So don't assume that you're going to just walk into these markets and do well. There's definitely an education point. But if you look, at every point, I'm not going to belabor this point, but at every point where I have an arrow ending, there was some price action. A lot of times it might have been a little pause. I think that this area is quite interesting because this pivot, I'll erase these lines. I put a lot of lines on here. This pivot was caused by an overshoot and an overextension. And then look what happens when we get back there the next day. Well, not next day, but like in next 2 weeks, we have the same kind of overshoot and extension here. So it's pretty obvious there's something going on around that level, right? And, even here, not much action, but a lot of times there's back and forth. Now, why are we talking about this? Actually, here, let's go to another chart showing the same thing. I won't talk about this chart, but here's a stock. So why are we talking about this? Well, because if you want to play for extension beyond the previous swing, you need to be aware when you think about how to manage trades that this is a spot where you can pick up some noise in the market. So if you tend to tighten your stops really closely, really aggressively, and I'd love to tell you, I can make your life easier if you can learn from my mistakes. You don't have to repeat them. But one of the mistakes that I made when I transitioned to swing trading, because I had, I had done thousands of trades where I got out at the previous pivot. So then when I go to trading on the daily chart, do you see what happens? Even though I'm not going to get out at the previous pivot, I'm going to try to play for some bigger swings. I'm so focused on that previous pivot that any type of jiggle around that previous pivot would get me out of the trade. And as you will see, and I suggest that this is a pretty good homework exercise, go through a bunch of markets and look what happens around the previous pivot. Just to be clear, what I mean by that is you're taking like this high here, and you're carrying it forward and looking what happens when the market gets there. And this is a kind of nasty trading stock currently. It trades okay sometimes, but what I have here on the chart is really pretty noisy. Just be aware there's going to be some stuff happening there. So if you know that, it will put you in the right frame of mind, and then you can think about how to manage the trades. We'll look at that here in a moment. So one of the other possibilities is that the thing just extends into further swings. And you certainly see here, there's a bonus here, by the way. I'm going to share something I think is really important with you. So look at all of these pullbacks, and they just keep going. This certainly does happen sometimes where you have a market that makes another swing down, another swing down, another swing down. And this is, you got to decide if you want to play for this kind of action or not. Of course, it seems like you might want to. But, even here, let's look at those previous pivots. In this case, we do kind of knife through them, though there's a little bit of action in that area, right? Sometimes. So this is not really on the curriculum of the course, but I think this is a very important pattern to talk about, the ante. There are people who do nothing but trade the ante. And what the ante is, so this comes from Linda Raschke's work, and a book, I don't know, early 90s, called Street Smarts, which you can certainly still find. It's worth reading the book. It's also worth just to be perfectly honest, it's worth crunching some of those numbers yourself, because things always change in the market. And I certainly don't trust any test that I did not do myself. So I would not take everything in there to be gospel or written in stone. Use whatever whatever your favorite religious metaphor of the day is. But I think the ideas are very important. And she, in that book, came up with a trade that she called the ante, that was based on an oscillator. And it was an oscillator that is basically what we use here, the 310 oscillator, the MACD. So here's the zero line of the MACD. I'll use a little bit of colors here. So we talked about the first cross, right? Talked about the first cross trade on the indicator line, and this is a little bit different. So what you have here is you have the slow line that's kind of doing its thing here, and it's led, and I can't promise you that my lines will actually make sense, but so here's the fast line. The fast line does something like this. So what you have with the anti-trade is right there where I wrote at the end. This is how she originally described the trade, that it was the first time the slow line turned up and the fast line turned down. So the idea was you have the lines moving against each other, against anti. That's where it comes from. And when I wrote my first book, I used this trade. I asked her permission to use the name, and she said, fine, no problem with it. But so the thing that is kind of interesting here is that this idea, what you're showing is that you've had enough of a swing down here in the intermediate term momentum to set up a downswing. It's another way to define pullbacks. And then you have those two lines going against each other, which shows that the short-term momentum is in conflict with the intermediate term momentum, which is longer than short-term, and that sometimes sets up a trade. So as I have used this pattern over the years, I have actually disregarded the indicator setup. I don't think the indicator setup is so important. Let's find the indicator setup here, just so you know where it is. So here's the slow line slopes up, see that? And the fast line slows down. So this is technically, and I'm doing something a little bit confusing here, this is technically an anti-setup. This also would technically be an anti-setup. The slow line rolls down, the fast line moves up. I don't think that's a particularly useful way to think about the pattern. What you want to look for is what the pattern, what the indicator pattern is capturing on the chart. And I can help you with that, absolutely. So let's say you have a market that is trending, and then the market has some sign of trend ending. Could be a little bit of a double top, could be a climax. We've talked about this extensively, right? But you have some reason to think, oh, this trend might be ending. And then what you look for is a sharp counter trend shock. The ante is this pullback. So you've had a market that's trending. Can this trade happen in a trading range or on a breakout of a trading range? It can, but it's not as easy to see, and I don't think it's as powerful. So look for a market that is trending, and then look for the first strong counter trend shock. And here the MACD will help you, because the MACD will make a new low relative to its recent price history. What's recent price history? 40 to 60 bars. So if you're looking at a daily chart, figure 2 to 3 months. If you don't have a comparable low on the MACD there, that confirms that this move was made on new momentum, and then you look for the first pullback. And this is a very high probability trade. It is a very high probability trade for a measured move objective. So this is, you want to be careful that you're not playing for a 1 hour target that is far outside the measured move objective. I hope that all makes sense. The point being here, this is an ante. So this is your first strong counter trend shock, and the MACD is probably not super impressive here, but it is pretty clear new momentum. Remember, we talked about one of the ways to set up pullbacks is to look here when you engage the lower channel. The thing about the ante is In most cases, the ante won't engage the lower channel. You'll set up around the moving average. This is not what I want my best pullbacks to look like, generally speaking. However, it is here because we have this change of trend. We have this new downside momentum. What was the evidence that we were maybe running out of steam? Well, you could look at it here. You have 3 pushes up here. You have some kind of weird semi-climactic action here. You also have a little bit of a rollover. So that would have definitely put me on alert that there's a potential end of trend. I don't have to short the thing. Shorting the thing here in this range is frankly kind of stupid to me because I don't know what's going to happen. But once I see this combination, the boom, the powerful move down, and then the little bit of a reluctant bounce, that's kind of the same thing, right? It's just where it sets up structurally. By structurally, I mean in the market structure, in the life of the trend. That's what makes this different. How long have I been talking about the ante here? I don't know, but that is another one of those nuggets that if this is a new pattern for you, you don't have to call it the ante, call it the first trend change pullback or something like that if you want, but that sequence. Wait for a market that looks like it's running, a trend looks like it's running out of steam. First strong counter trend shock, and then a reluctant bounce for a short, and then look to enter that pullback. If you focus on those, you will find those are very, very good trades. Now, why is this not all we do? It's very subject to the market environment, which is something we're going to talk about in a moment. You'll go through long periods of famine. It's definitely a feast and famine kind of thing. And on daily charts, at least, they don't set up enough to really justify building a whole trading program around them, in my opinion. Maybe your experience will be a little bit different, but this pattern is this alone is worth the time we've spent together in the course. So that's not even in the official documents, but there it is. So we talk about the success being a 1 hour target. Problem is you have different entry points, different stop locations. Your 1 hour might be, who knows? So the one thing that I do want to consider, and the answer is yes. Would you ever have, so let's say you have a pullback here and your 1 hour target is here, your 1 hour target is clearly above that previous pivot. Is that okay? Yeah, that's okay. But just be aware of what you're doing, and also be aware that when you get to that previous pivot, you're likely to have a little bit of garbage happening there. So don't be too incredibly reactive if you're reaching for your 1 hour target. Okay, let's talk about how pullbacks fail. These are snaps from my first book, The Art and Science of Technical Analysis. These show what, one of the things that I think is interesting. That book was 10 years ago. My thinking has evolved in some ways, but this idea of these 3 pullback failures, there are 3 common ways that pullbacks fail. There is the failure at the previous pivot. That's what we're showing here. There's the failure by strong momentum against, and that's what we're showing here. And then there's the failure by just going flat. These are things that I think about daily in the market, and these are very, very useful templates for thinking about how pullbacks fail. And if this is new for you, I would program this into your head. So just a few more examples of what these look like. Here's an example where you might have been buying this bull flag, broke to new highs, had pretty decent momentum, pretty decent looking complex pullback, right? So there's justification for entering, and you might have entered long on this bar that I'm touching there. And this is the nasty failure, because there's not a lot of these, but this is the kind of trade where you will get in and your 1 hour loss is hit the next day. Now, in reality, I'm tightening my stop after that initial move. Here's actually a question about the ante. I do want to go back and fill this in. Somebody asked if it works as well on the long side. It does. I think you don't see as much of them set up, but of course, be aware if you're talking currencies, what's long, what's short. That's a separate discussion we can have. But yeah, I think you will see, particularly in stocks and intraday as well. Intraday stock indexes, intraday gold. You'll see a few more sell antes and buy antes, but yes, it's perfectly valid to the upside. So sorry about that. I know it's kind of like, maybe Tom, maybe we need to edit that so it makes more sense. But what you're looking for here is there's frankly not a lot you can do about this. This type of failure is just the nasty one. What you could do here is, let's say you're buying this pullback, and let's say your stop is really far away. In reality, my stop's not going to be that far away. My stop's going to be hit on this kind of crappy bar. But if you have this kind of action here, and then you start to stabilize here, that's a general principle. If you have a big move and then you stabilize even for a single bar near the extreme of that move to the upside or the downside, I'm not drawing a candle here. What I'm showing here with this bracket is that, in the next day or the next couple of days, you're trading in the lower part of that big bar. That very typically sets up a continued decline. So that would have some implications on how you manage trades, right? And here's another example of strong momentum against. You bought this nice looking flag, and then all of a sudden in one day, it's not a nice looking flag. So this is, to some extent, maybe the worst possible outcome with a pullback, that because it doesn't really give you a lot of nuance, it doesn't give you a lot of opportunity, a lot of interesting trade management stuff. Your stop just gets hit, and you go punch something soft gently, and you put on the next trade. The other thing that can happen is you get into pullback. So let's talk about a bear flag here. So you get into a bear flag, does this nice little bear flag thing, rolls over, gives you a little entry, and then it just goes flat. Now, there can be several outcomes here. It is possible that we might need to just spend some time stabilizing, and then the thing can sell off. But what is pretty clear to me is that this scenario is quite different than this scenario, where you have the pullback and then you roll over, and then there's sell, sell, sell. There's or flip it, and then there's buy, 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 where you have real momentum. You have people really driving the market. This area here, at least, like, it's obvious people just aren't that interested in being short this market. So again, this has implications for how you manage the trade. And sometimes you will see that, like, look here, the market did try to go, but it didn't happen. And sometimes you will see these sideways ranges either work out, or sometimes you'll see them, then you have the strong momentum against afterwards. But it really, and you might think that there's some intelligence you could pull out of being able to read market structure, that there might be things that you could do here that would help in terms of basically figuring out, like, which trade should we stick with, which trade should we get out of. I haven't had really good success with that because I'm not trading a range. I didn't get into the stupid thing to sit with it going sideways for 4 weeks. So once my original reason for being in the trade is violated, I really don't have any business in the trade. So you want to train your eye to see when these things go flat. Here's another good example. And, by the way, is this even a failure? Because we did get back to that previous pivot, and then we had another little pullback. So, you might say, is that some kind of nested flag? See, there's lots of ways to reach these, to read these things. But again, what's pretty clear is, and this is a 5-minute S&P chart, we did not have the strong momentum carrying us to highs. Also, if you're an intraday trader, and this is not a day trading course, but you certainly want to be aware at the time of day, and we're coming into the end of the session there, so that means something else. I put this chart here. This is a bad example. This is deliberately a bad example. Is this a failure? Is this a pullback failure? I would argue it's not. So this is not a very nicely trading stock recently. Look at this. So you're going up, you have a strong hit against, and then somehow it ends up, these rules where we're saying what sets up the best pullback. These are guidelines. They're good general principles. Sometimes weird things happen. And if you were following the stock and you saw, oh, it's perfectly capable of recovering from a big drop, and look at this, what's with that's kind of a crappy bar, and we just continue higher, you might say, okay, I can bend my rules for this stock, and I can look to trade after big momentum down. But the reason I say this is not a particularly good example is you don't have any business. This looks like maybe we failed by going flat, or whatever, but you really don't have any business even looking for a pullback here because this is not the kind of case where you had a market going up and then makes a nice little pullback. This is a market going up and then collapsing. Actually, it probably should be more vertical, right? Market going up and then collapsing like that, pretty much. It's not a pullback situation. So as you evaluate charts yourself, then you need to look for things like this and say, should I even have been in the trade? And in this case, it's pretty clear you didn't. The slide probably doesn't even need to be there, but those are, I've seen people sometimes kind of get confused. The key thing is to understand price acceptance or price rejection. I think this terminology shows up first in Wyckoff. I can't swear that nobody else ever used it, but price rejection just means that you have a level here, and let's not worry about where the level comes from or what it is, and the market goes up to that level, market moves up and trades around that level, and as soon as it touches that level or gets close, and it might not be as soon, but pretty much there's a sharp move away. The price does not want to be there. And the opposite, of course, is price acceptance. And price acceptance happens when we either set in around the level, maybe we consolidate beyond the level, and that can give us a little edge for continuation. This is also another very valid route for homework. If you spend time really looking at action around previous levels and understanding how price rejection unfolds, even this is a case where even some multiple time frame work can be useful. But this is what we're really getting back to here, is that you need a plan. We'll talk about that next. The next session is there's quite a bit of talk about trading plan. You just got to know what actions you're going to take so you're not making it up each time. And this is to emphasize the importance of looking at price action around those previous pivots. Summary pullback outcomes. So the trade working, we can extend to the previous pivot, which is pretty low bar, but it's a good place to start. And then we can extend into either one more trend leg, or the thing can just keep trending. And that seems very obvious to say that, but it's quite, once you start to structure your thinking like this very carefully, it will affect the way, not only the way you see the market, it will affect the way you manage trades and what you do. And that's the whole goal. And then be aware that these 3 failures, you probably can come up with other failures. And if you come up with one that you think is important enough that it kind of deserves its own category, let me know. Maybe there's some other way that I should be thinking about these things too. But I have found that looking for a failure at the previous pivot, looking at a failure of the market going flat, or the strong momentum against the trade, that kind of sets my mind up for understanding how all of this works. So you also want to think a little bit more, and we've drawn this a few times, about where we are in the market structure, that you have different expectations for these ongoing pullbacks. After you've had several pullbacks, you might have a you might have a complex pullback. You might have a pullback that lasts a little bit longer. You might even have a little bit of a downtrend so before you continue. So you do definitely have to understand where you are in terms of trend maturity and the ongoing unfolding of market action. So let's talk about now what you do with that. That's all kind of theoretical. It's like if we're learning to operate, we just looked at books. We just looked at pictures of anatomy. We just looked at, maybe models. But now let's talk about what actually happens when you get the tool in your hand and when you actually do something. So trade management falls into this. You really have to define this for yourself, because there are a lot of possible branches. And I want to simplify it today to thinking about the protective stop. So where do you get out when the market moves against you, or where do you get out when the market moves in your favor? And we'll talk about these things. We'll probably mostly think from the long side, just flip it to the short side. So the protective stop further separates into the initial stop. When you put the trade on, where are you getting out if you're wrong? When will you raise the stop? Will you raise the stop? Will you ever widen the stops? You get into a 1-hour trade, and let's say your entry's here, your stop is here. Will you ever move your stop lower? Right away, many you're like, no, I'll never do that. And maybe you should never do that, but it's worth thinking about. It's worth asking the question. And then profit target. Are you even going to use a profit target? One way to get out of a trade is just to get out on a trailing stop. You're going to use a fixed R target. So use like a 1R, maybe a 2 or 3R target. You're going to get out all at once. You're going to piece out, right? So, these are the kinds of questions we'll think about. Initial stop. So you can set this based on the entry pattern or on volatility. The one thing that I would not do that some old school traders are still doing is to just use a percent of price. That does not make any sense to me because it's so easy to measure volatility. And if you don't want to use an indicator, I don't use an indicator. I do it based on what I see on the chart. But what I'm doing is a heuristic for volatility. If the market's more volatile, bars are bigger, I put my stop further away. Why would I use a 3 or 5 or 10%? And when I say percent, I just mean of the price. That makes no sense whatsoever. We have much, much better tools. So I do like to set the stops on volatility. I would prefer a range measurement. So whether you use ATR, there are other ways to measure range. I would prefer that over a standard deviation based measurement because the standard deviation measurements like historical volatility, which we use for options a lot, but they measure close to close, and your stop's going to be hit on the high or low of the day. We won't talk about stop close only. It's worth a very brief discussion here, but so SCO, stop close only, that means that if it's a $50 stock, 50, and my stop is at 48, that stop will only be executed if it's below 48 on the close. Now, the problem is, what's your actual risk? Because if the stock collapses and it's 35, it's not going to be executed until close. So the advantage of the stop close only is that you're not going to get wicked out. And it's worth thinking about. If you are frustrated by constantly getting wicked out, I traded a good portion of my trading career using stop close only. It seems like a stupid idea. I'm telling you, it's not a stupid idea, but you definitely need to be prepared. There are going to be times that you have losses that you're like, oh, so and the problem with that is that particularly if you're a stock trader, that's a lot of those could come on one day. So I would believe you could very well trade for 6 years and not have significant slippage, and then all of a sudden have a boatload of, I don't know, 4 or 5 hour losses on one single day. So you could have, what does that do to your account? Kind of feels like a 40% drawdown on a single day. You need to be aware of that. Now, this doesn't mean that if you use stop close only and you think you're in one of those disaster days, you could make some decisions before the end of the day. But what's the offset? You need to be aware that decisions made before the end of the day under pressure a lot of times are not the best decisions. They tend to be emotional decisions. These are all things you need to think about. And why do I spend so much time contradicting myself and walking through logical mazes? Because this is the maze that you have to walk through to create your trading plan. You have to, I don't want to just tell you there's only one way it can be, but for you, there's only one way it can be. You can change that way, but there's only one way it can be. So, if you do decide to use stop close only, you need to consider possibility carefully. Do be aware that if I don't measure ATRs when I put stops in, but you can measure where the stop was after the fact, right? And based on a 20-day ATR, my stops tend to be a little bit more than one ATR. I've gone through periods of time where I've used 3 or 4 ATR stops. The bigger the stop, the longer you're going to be in the trade because the bigger the profit target. The bigger the stop, the less likely you are to get ticked out in noise, but you're also going to have a smaller position size. And one of the things that I think about more and more as I get older is that actually being in the market is a risk. So there is, and that's a truth that not a lot of people think about, but there is an inherent advantage to shorter holding times because you're in the market for less time. And if we can, move in and out effectively with shorter holding times, that removes certain kinds of risk. Initial stop location from a practical standpoint, let's assume that my entry technique, which we talked about in the last session, let's assume my entry technique got me short on the break of the low of this bar. That I recognize that this was a little bit of a overextension to the upside, maybe tiny bit of turn of momentum. And so let's assume that my entry was right here. Okay, so let me clear those lines. My entry is here. My initial stop is probably here in most cases. Now, what this means is if this thing happens to do a complex pullback, I get stopped out. And if what I'm looking to do is to tighten that stop aggressively, which we'll talk about in a moment, other possible stop locations, my stop could be here. Gives me a little bit more room. My stop would not be much higher than that. Now you got to decide what's right for you. But I think if you're getting into a pattern like this and you're putting a stop up here, then you're trading for a much bigger move in the market. Is it viable? Well, it probably was more or less in this case, but you just need to be aware of what you're doing. And thinking about scaling in and out, we won't talk a lot here. The problem with being, so you can scale in or out, or you can be all in or all out. You also can scale you can use scaling on the entry, scaling on the exit, or scaling on both. So in other words, you could be like an all-in trader and then you get out in several pieces. Or you could do the other way, right? You could get in several pieces. We talked about entering as the thing moves against you, and then you could be all out at once. Or you can figure that out. These are the kinds of questions you need to think about. I'm not going to read the slide to you, but I'll just highlight a few things here. The most important thing is to think about whether, if you're scaling in, we typically think about scaling in like you're buying a pullback. You buy some here, you buy a little bit more here, and you buy a little bit more here as it moves against you. That's how we usually think about it. But will you buy some here, and then when the pullback moves, will you buy more there? Can you buy and profit? That's worth thinking about. The other big question is, how do you know when you're wrong? Because at some point, you're just wrong. You put on your full position and you're wrong. You also need to be prepared that these easy trades, what I just drew looks like a huge win, but if you scale in, you might only have had on 1/3 of your position for the easy trades. So you definitely need to be aware there's a little bit of an offset there. Scaling out, you need to know how many pieces you'll do that in. You also need to think about, will you ever add back? There is certainly the possibility of entering a trade here, scaling out, entering more here, scaling out. It doesn't really happen that often, but there are points where when the market makes extended trends, if you're trading a very disciplined pullback approach, that you can just keep adding on each pullback, and then you take partial profits here, and something like that. So you're not accumulating a giant position size, you're accumulating a larger position size, but you're also doing it in context of taking very consistent profits. So that's a way to think about it. These are all questions. If you choose to be something other than all in and all out, you need to think about all the questions on this slide very carefully. Initial profit target. So possibilities, let's go back here. This is the same chart. Let's say you entered short here. So, one profit target is to use this previous pivot. We've discussed that. In this case, the previous pivot would be beyond a 1R target. So you also certainly could use a 1R or 2R, 3R target. You can use other market structure. You also can have no initial target at all. Nobody's telling you you must have an initial target. We're going to talk about the trade-off there in a moment, but there probably are other ways you could set targets. It gets a little bit complicated, but you could potentially set volatility-based targets. You could use a 2 ATR stop and a 5 ATR target, but what you're doing there is you're really using an R multiple too. A lot of this collapses down to being based on the geometry of the initial stop. And I don't think that there's a lot of value. You can build in all kinds of complexity, but you could, for instance, use different periods of ATR for your stop and target. Why would you do that? I suppose you might justify that okay. Well, I just came up with a justification for, if you wanted to do that for marketing purposes, what you would tell people is the pullback itself is a short-term pattern. We're using a short-term ATR, but we're trading a bigger picture market structure. See, so we're using a longer-term ATR to set our profit target. In practice, I've done a lot of system development. I've not found something like that to be particularly valuable. It's possible though. All this is to say, you got to know what you're doing for yourself. You have to have rules. Let's look a little bit about let's talk a little bit about trailing stops. So there are good out-of-the-box algorithmic tools that will work. Parabolic SAR is one. You need to deal a little bit parabolic SAR, and if you don't know what I'm talking about, it's not particularly important, but it's a tool that will ratchet a stop up behind a move, and there's an acceleration factor, but there's also a measure in the ATR, which is the crossing of move. I'm sorry, there's a measure in the SAR that is just the crossing of two moving averages that defines if you're in an uptrend or downtrend. And sometimes that will flip inappropriately in your trade if you use this tool. So you might need to massage that a little bit to make sure the tool helps you stay in the trade. And there are other ways to do it. You can have a version of this where it knows your entry pattern or knows your entry point, and then it will calculate for that. But that's a possibility you can use for a trailing stop. Chuck LeBeau's chandelier stop is a similar concept. What the chandelier stop does, and this is one that I have used algorithmically, it looks at a trend, and you still need to have a way to define when the trend flips, right? And it looks at the highest point the trend has reached, and it hangs a stop a certain number of ATRs underneath that high. So what it means is when the market goes flat like this, it's still calculating the stop from that previous high. And there are variations of that. A lot of people use moving averages. I don't think they're great tools, but it's probably better than none at all. If you get in a strongly trending market, you say I'm going to get out of the 9-period ATR. I don't know why I'm doing that. I'm sorry. I'm thinking ahead to a couple more slides. And you think I'm going to get off the 9-period moving average is touched. Okay, that's okay. You also could say, I'm going to get out if the 4 crosses the 15 or something. You can set up all kinds of things like this, but don't be recreating it for every trade. If you're going to tell me that you use the crossing of moving averages to get out of extended trend trades, then you got to use that for every trade. You really need to be very consistent. You also can use discretionary trailing stops, and this particularly for system developers is a terrifying word, but let's talk about how to do that. So the challenge is finding the right balance. Balance between what? Balance between protecting profits and not getting caught in the noise. That's the delicate dance. And look, this is one of the things that for about 10 years, I published daily trades for 2 firms, and we made these available for free for a year or two, and I think some people made use of this information, but basically I updated trailing stops every single day so people could see how we did it. And I'm going to walk you through the methodology here. For those of you who are Market Life members, this is also something we do every day for the underways. We're suggesting, generally speaking, that you're taking 1-hour targets, but we are looking, if you were trading these for bigger moves, what would how would you trail the stop? So you're seeing there's a certain amount of learning that I think has to be almost in kind of an apprentice type of concept, or structure. So you see, I can tell you how I think about it. I can tell you the tools, but I can show you the tools. But when you see them put into operation month after month after month in the same consistent way, you'll see it works like magic. It's very rare. It did happen for those of you who are Market Life members. We got stopped out of a crude oil trade, a week and a half or so ago. We kind of got ticked out in the noise. That doesn't happen a lot. More often, if you use these approaches, you're going to be in trades that you're going to think it's like, how did that work? How am I still in this thing? And then we'll have the discussion about whether you should even be doing this. So let's jump into the principles. You got to decide, are you a trend trader or a swing trader? These are 2 quite different approaches, and I don't think the trading community necessarily understands the differences. So in my mind, if you're a trend trader, a trader who wants to follow trends, you want to be in the trend if you possibly can. You want to err on the side of not getting taken out by the noise. So this means you might very well get into a trade. It might go 8R in your favor, and you get stopped out of that trade with 2R. So you get back a lot of money. You got to be willing to give back a lot if you're a trend trader. A swing trader has a different reason for existing. The swing trader only wants to take one clean swing out of the market. If I'm a swing trader, I do not want to sit through noise. I do not want to sit through pullbacks. I want to be kind of twitchy appropriately, but I want to get taken out by a little bit of a move against my position. I'm going to approach this as a swing trader because I think if you're trading these pullbacks actively as a swing trader, this is a constructive way to think. If you wish to trade pullbacks as a trend trader, you could do worse than this. What you can do is buy every pullback in a market and just wait to lose on the pullback at the end. There are some old school traders who basically follow this approach. You now have, this is not how I choose to live my life, but you now have enough knowledge from the hours that we've spent together looking at market structure, looking at how pullbacks work. If you want to be a trend trader, if you want to be a trend trader, there are all kinds of like channel breaks out, Donchian breakouts, right? Moving average cross signals that get you into trades. You certainly can do something that I think is a little bit more sensitive than a lot of those approaches. And you literally could buy every pullback, short every pullback in a declining market, and just keep doing that until eventually the trend ends. You have enough information to build a trading plan and to put that into operation. I don't want to talk much more about that because it's not how I look at markets, but it is a viable way to trade. People have built substantial fortunes trading like this. You have to be prepared to sit through some volatility and noise, and it's it's a bit of a crazy life, but it is possible. Thinking as a swing trader, here's how I trail stops. Stops only move to reduce risk. Now there are rare points where, and by rare, I mean probably not twice a year. If you're a fairly active trader trading on the daily charts, probably not twice a year will you widen the stop. And usually when I widen the stop, it is in response to a mistake that I made. It does not, I'm quite consistent from a discretionary standpoint, but there still is a time where I come in, I'm like, what was I thinking yesterday? That stop is too tight. I need to widen that stop. Never past the 1 hour target, or the 1 hour initial stop is a line in the sand. I can never go beyond that. But if I have tightened a stop too much one day, then I can widen it the next day if that was a mistake. Don't even think about that. I would not do that until you have several hundred trades under your belt. The other place where I might do it, which almost never happens, is if a consolidation develops in some, there's a subset of ways where I think maybe we need a little bit more room. I'll widen the stop. This is not a critical thing, but I can't tell you in good faith that I never widen a stop because there are some extremely rare cases where I do. Stops stay out of the noise. You have to have some distance. This is the big one. Stops should respond to momentum. So when the market gives you easy money, ring the register. And in this case, you ring the register by reducing the risk, by tightening the stop. Stops also could respect signs of failure. What's that mean? Climax, all these typical trend ending patterns. And you also might use time stops. What's a time stop? Well, you get into this trade. Let's kind of draw this here. Okay, you get into the trade and it doesn't really work. So you put your stop here, and then as the thing goes sideways, even though it's not really moving in your favor, that's the stop that I'm drawing there. You tighten the stop just based on time. You also could have a time stop that says if I'm in the trade for 2 weeks and I'm not profitable, I'm out of the trade. That's a possibility too. Let's look at an example. So here's a pullback daily chart of the S&P, and let's say that we identified the complex consolidation. We also identified a little bit of a failure test here at the bottom, and we were willing to buy above the high of this bar for entry. And we do know that if we buy tomorrow, our entry will be here, and let's say our initial stop is here. Okay, so that's a pretty typical trade. Your initial stop might be slightly different, but that's roughly what we're looking at. Here's the next day. Okay, so we entered, our initial stop was here. Now, this is the best possible thing that can happen. Well, I mean, best possible thing happens is it hits our 1 hour target on the first day, but we're trailing a stop. And after this day, after we've had strong momentum, I'm going to tighten the stop to about here. Maybe even a little bit tighter. My range of stops could be somewhere here, somewhere here. I am not going to go into that previous bar. As you will see, there are cases where I go into that previous bar, but here when the pullback is just starting, I don't want to be that tight. I'm also aware that I have this pivot up here, right? So I probably will see some back and forth at that pivot. I don't want to have my stop here because if I have my stop up in that bar, I'm just going to get stopped out. So after this move up, your stop is somewhere in that range. Next bar. Okay, some little bit of garbage, right? And if I had tightened into that bar, I might have been hit. This is a bit of a doji. It's not technically a doji for you candlestick freaks. I'm aware of that, but it's a day where we had action on both sides. We ended up basically where we opened, and it is a relatively small bar. It's not quite an inside bar, but all of this action is happening near. So look at this swing. So it's a 2-bar swing off of that low. So there's the swing, and then this day's consolidation definitely happened in the upper part of that swing, and that is usually bullish. So I would tick my stop up just a little bit. I'm still not in this bar, but my stop is just underneath that bar. I still want to leave a little bit of noise, that if there's room for noise, that if we have some more sideways, I don't get taken out. Next bar. Okay, now we have an inside bar. This is potentially a little bit more explosive. This is a case where I might justify a stop close only. Here's how I would do it. So I still have an airbag stop here, right? The next day, maybe my stop is now right at that low or just a tick beyond. However, if we close under this low, I'm going to get out of the trade. So there's a little bit of nuance there, right? If we break down and we close here under that low, I'm going to be out. So that's a stop close only, but I'm still working my hard intraday stop here. So if we just fail, and I'm aware that's what's happening here is that action around that previous pivot. So if you don't want to use the stop close only, then you just put your stop here at the previous bar's low and let it go. Okay, not great action, doesn't really change everything. A little bit of a failed breakout, but it's not much of a failed breakout. This is not enough to take action on. My stop, however, might come up a few ticks higher. So now I'm definitely slightly inside the low of that bar. Okay, good momentum. So good momentum. Now I have two choices. I could justify a stop right here. I could put a stop near the low of that bar because I don't need to live with a failure. The other place is if we go back into this consolidation here, I want out. Those are the two possible points for a stop. And what we're responding to here is that when we get momentum in our favor, the stop moves aggressively. Remember, our initial stop was down here. So we have tightened the stop quite substantially. Gap and go the next day. This case, to me, this is quite simple. My stop is right here at the low of this bar. What's happening here? Okay, well, now here's a point where maybe my stop was a little bit tight. So, now I'm living with a stop here. Is this a little bit tight? Do I need to widen my stop? That's the question I would ask. And I probably wouldn't. This is kind of the same thing that happened here, right? We're just consolidating near the high of that bar. I would live with my stop there. Another little consolidation. You see this, right? This is all of this action. It's very similar to what happened here. It's the same kind of thing. It's the same kind of stair stepping higher. I have my stop still basically in the same place. Same thing here, but now that we have broken out, now that the trend is a little bit more extended, I'm going to be a little bit more aggressive with my stop. My stop is going to come up here, and if we take out these lows, I want to be out of the trade. We trade higher. So at this point, my stop again, this is a consistent thing. Good momentum higher. We're now extended above the upper channel. I'm going to come into that bar a little bit. And here, it's looking like the same thing. I'm going to live with my stop right here. Really no change here. Maybe I'd tighten my stop a little bit tighter. I would tighten my stop a little bit tighter. Okay, so now what's happening here? Well, I'm a swing trader. I don't want to sit through a pullback. This looks like a pullback could be forming. However, my stop is here. I don't have, my stop is here. I don't have enough momentum in my favor to really justify tightening the stop. If I tighten my stop above this, I'm going to be stopped out a lot without any great compensation. So I do not tighten the stop here. We break higher. What do I do?
What do I do here? Strong momentum in my favor. I come into the low of the bar. My stop is here. See this? This is actually, it's highly discretionary. It's quite consistent though. This is a little bit different. This is not this type of consolidation, right? It's not the same thing. We did break higher. So my stop now comes up here. I'm leaving a little bit of room under that low. I'm stopped out. And it turns out, so my stop is hit here. We had a free bar above the channel. My stop is in the right place. It's a fine place to be stopped out. We do roll over into a pullback. If I was not stopped out on this bar, I definitely want to be stopped out on this bar. So if you're a swing trader, you want to be stopped out here. You don't want to see this and have your stop down here. There's no point. And in this case, here's what ended up happening. This was back here. So you might have squeezed out another little move with that wider stop, but on balance, that's not how you want to live as a swing trader. Your goal as a swing trader is to take one clean swing out of the market. And to my eye, that's the clean swing. Even though this is consolidation, this is a pullback, right? Why do I want to sit through 4 days of chop if I don't have to? That's not really what we're looking to do. And that, I hope that was useful, going bar by bar like that. That is just a little bit more insight into my thought process. And this is what, eventually you can do this very, very fast. But you see the key thing is that we're tightening the stop when momentum works in our favor, when the trade moves in our favor. Again, the goal here is to be in for one clean swing. Perfectly happy to be taken out on a pullback. I don't care that we ended up going higher. That's not my problem, because why? I'm in for one clean swing. You have to define that. Be a little bit patient with flat markets, and you've seen, here. What do I mean by a little bit patient? I mean a little bit patient. Like, you're not going to react too much to this. You're not going to react too much to this, but that once you have a little bit more volatility and pullback, I'm a little bit less patient. You got to figure out what's right for you so you can be as consistent as possible. But you definitely want to try to find that balance. This is the big one. Always tighten with momentum. When you get a big bar in your favor, your stop can go into that bar. Now, let's say this is a candle up, stop can probably be here. Your stop probably can't be here. Like, that's probably too tight. You're just going to get stopped out. And you saw that happen here in the middle. There will be times that my stop is here, but depends on the size of the move. If you've had a lot of little bars like this, and then you have a giant move like this, then yeah, maybe we really want to lock in some profits. And you always want to respect the potential for noise, especially when that noise comes when the market breaks out of consolidations. Now, looks like a great approach, and it is a great approach, but you need to ask yourself, should you even do this? And one of the things that we have discovered is that with certain kinds of approaches, trading pullbacks, you might actually make a lot more money just simply taking 1-hour profits. The thing about trailing stops is that, especially if you piece out, you're going to take a little profit, little profit, little profit, little profit. So you will eventually sometimes have these things that go crazy. I still tell stories years and years ago. I got like a 30 some hour profit in the euro. And I still remember that, but it was on a tiny, tiny piece of the position, and it really didn't make that much money. And it's certainly inappropriate for me to be thinking about that years later, even though, it felt good, it looked good. You should do a lot of careful work, and this is important. It's easy to miss important things when somebody's talking to you for hours, but you definitely should consider the viability of taking full profits at 1 hour. That might work better than you think, and we found that with a lot of our trading. And also, the advantage of 1-hour targets, one of the advantages is that it reduces your time in the trade, and reducing your time in the trade reduces a certain kind of risk, right? Definitely worth thinking about. So, a little summary of where we were today. We looked at what happens after a pullback in
in the context of like theoretical market structure, and then we looked at how to put that into operation. We looked at stops, initial stops, trailing stops, and we looked at profit targets. Should you use them? You also can use profit targets and trailing stops together. It is a possibility, but it's not that a trading approach can't be complicated. I've traded approaches that require many, many pages to explain, but you definitely do want to tend toward simplicity. So if if you're getting something that's pretty convoluted, you might be building up more complexity than is really worth it. So just consider that. Let's look at some current examples. Actually, a few questions here. I'll hit these questions. Going bar by bar was a very useful for me. Thank you, Simon. Would the same approach apply on a 5-minute chart? It does. On intraday charts, I tended, when I was doing this, to so if you're an intraday trader, there are 1 to 2 big trend days a month. And if you can catch those days, what a lot of day traders do is they'll kind of chop around and not make a whole lot of money most days, and then all of their profits will come from 1 to 2 days a month. That's perfectly viable. There's nothing wrong with that. You also need to understand, if you're a mean reverting intraday trader, what the roller coaster you do not want to be on is where you make money almost every day out of the month, and then you give it all back on one day into that. You're basically fading a trend day. That's a very dangerous thing to do. So if you're trading that trend day, you certainly can, you certainly can use some kind of trailing approach like that. And it works on 5-minute charts. It's a little bit more noise, and you do have to make decisions pretty quickly, but not unnecessarily so. Thank you, Daniel. Daniel just said that some nice things about the course. Thank you. We answered the question about the ante on the long side. Yep, got that. Can I give my opinion on a high tight flag and the entry point? So we'll look at a high and tight flag, I think, today. And yes, they do bring some, I would trade those in certain market environments. So we've seen this in recent years, where there are a lot of these high and tight flags. And what he means by that is you have a stock that's trending, and then it just puts in these few little crappy bars near the highs of the move. Imagine a daily chart. Let me go back here. A daily chart that has an entry like this. This is a high and tight flag. They're difficult to trade because if you put your stop where I've suggested, your stop is here. Your stop is so ridiculously tight. So I would use a little bit wider stop is one thing I would do for high and tight flags, and I would be sensitive to the overall market environment. There are times that you have to trade them. It's a little bit of an uncomfortable structure it's uncomfortable structure for everybody to trade. I can't say that. I love to trade high and tight flags, but there are times when we have to trade them. It's a good question. Is it better to enter multiple legs with one trade, or enter separate trades for each leg? Well, we talked about that, right? So it certainly is possible if you are here. So here's kind of the ideal, right? If you can do this, and I have not been able to do this with any degree of reliability. So but there are times it's possible. So you enter your full trade here, okay? So you are +1 here, meaning that you have on your full position size, okay? And then you take off half here. I'll just put a minus sign because, as you've seen, I am not capable of writing on the thing. So then living through this pullback, we took half our position off, so we still have half a position on. So now you enter another full position, and then you take off half of that position here. So what you've done is you have pieced out, you've locked in profits, you now have a risk-free trade. And however, at this point now, you kind of have a +1. You have a full position size trade on here that is essentially risk-free. And, of course, that concept's not exactly true, but it's an okay way to think about it. And then what happens? You put on another trade here. You put on a full size trade here, and you take off half of it here. And now what do you have? Now you have on a 1.5 size position, basically for free. And you have you have to be extremely disciplined doing this. And eventually you can work up to where in these rare cases where the market really trends, where you have on a substantial position and you've taken profits on every piece, and you kind of reach this no can't lose on the trade situation. One thing you do need to be aware of is that you will have on uh, you'll have on a very large position if this works, and then your daily account swings will be big. Let's just put numbers on it. Let's say you're used to your account swinging $2,000 a day, plus or minus, you're okay with that. But if you build up these big positions, then you can find, and particularly volatility also explodes at the end of a trend, so you can find your P&L swinging 8, 10, 15,000. It can be a gigantic move compared to the 2,000 you were used to, and that can be very, very difficult to manage psychologically. So you need to be prepared for that. That's a possibility. You also can treat each one as just fully in, fully out, or you can use the kind of sticky trend following approach. Let's use a different color here. So let's use blue for the trend follower. So the trend follower might enter a full position here into this pullback, and then the trend follower might take a partial profit, or you might not. I don't know, right? But you might take a little bit of a profit, and then you might just continue to hold that position through the bigger move and tightening a stop or something like that. So there's all kinds of ways to do it. Is one better than another? I think for and again, it's very difficult to give a definitive answer because everything depends on everything else. And you will, if you make subtly different decisions, you can have vastly different outcomes. But for the way we trade, we found that being full out at 1R in some ways is more optimal in many cases. Where do you find your average loss relative to the original 1R stop? Roughly half typical loss, but again, that's a very personal thing, but it depends. If you trail like you did, I don't see an advantage in selling immediately 1R. Why not keep trailing with momentum until it ends? Terry, that's a perfectly valid approach. I think you said that before I went through that, but it's a smart question. What about measured move objective? Well, we've talked about measured move objective, Emil, and it's a good guideline. And there are some cases, I think, particularly with the ante, is a place where I am very conscious of the measured move objective, and I want to make sure that I'm not really reaching beyond that measured move objective. But it's violated. Basically, as we said, the thing about the measured move objective is that it assumes that volatility is going to be consistent throughout the life of the trade. And that's not always the case. So that's why it's not an always guideline, but it's a useful thing to be aware of. Dale says, thanks for going through the reason and stop setting. Good. I'm glad that was helpful. I may only have a specific 4-hour window to trade each day. Do you think it's viable to swing trade indexes in London intraday this way, or would a beginner be better trading swings over several days, assuming I would start slow and small? Well, start slow and small. Simon, I'm careful about giving definitive answers on intraday trading because it has not been a focus of my life for the past decade. So, I do have a certain set of skills and knowledge, and I did it well, but that the market may have changed in ways that, I try to stay humble here. I'm not sure I have the right answer, but I would think, depending on when that 4-hour window is, I would think I would have a difficult time learning to swing trade with only a 4-hour window, intraday swing trade. So what he's talking about is trying to stay with longer intraday trends. The problem you're going to have is that, again, it's only going to be like maybe 2 days out of the month that are going to be really rewarding for you, and you might really need to be engaged those days for the full session, or maybe even the aftermarket. If you're looking at London, when the U.S. trades, your indexes can continue to follow. So I would be concerned about that. Start slow, start small, paper trade. Look, intraday trading probably never sucks more than it does in July and August and part of September. So you're definitely heading into the difficult time of the year for intraday trading. So it's a good time to acid test it and to see, like what will this look like when the markets are flat and boring, and it's hopefully as difficult as it will ever be. Do you change stop target style depending on market or market condition? I don't, but you could. Do I recommend using fractional Kelly to estimate position size? I've traded Kelly, which was sort of like being shot out of a cannon into the sun. I've also traded half Kelly, which obviously, if you think so, half Kelly just means you do the math, you figure out what the Kelly size should be, and you cut it in half. And half Kelly tends to still be pretty aggressive. I'll tell you something about how aggressive full Kelly is. And it's also kind of a lax approach if you think about it. We do all this careful math, and then we just cut the number in half. Like, how does that make sense? But that is possible. And so let's jump into the current examples before I lose my voice. So here is yesterday's, maybe it wasn't truly yesterday, but here is a recent 5-minute S&P chart. So this is a really, really nice trade if you can wait for this trade. So, market opened here. We had kind of the back and forth setting up the range. We decisively broke to lows, and then we put in a flag. This is a really good intraday trade. This is one you want to catch. And then look here. This also looked like it was probably a good trade. Now, you might argue there's some sign of trend ending there. I would wave you away with that because intraday, if you see that and then you stabilize here and then you roll over, you really should be short. But you should have tightened your stop so you don't get caught in all of this. And there's not really anything definitively to look at, right? This does not set up, it's not enough momentum to get us interested in a long. Is this a tradable short? You maybe, and if it was a tradable short, by the way, you got your profit here, but it's not really the kind of move that I'm going to be looking for. You had one easy winning trade here, and then you had a trade that was a partial loss. There would be the way to assess the day. Sometimes things set up in the aftermarket. It's not a bad trade there. Not a bad trade there. This was last night, I think, so you can look and see how that played out. Other current patterns, so here's the Russell. This is one of the best patterns I see right now. This is a complex consolidation, and we can draw these parallel trend lines, and we'll see that this action is, and that geometry is respected many times, where you draw that trend line and you extend it there, and then the pullback runs into trouble here. And if you can establish shorts out of some noise that sets up here, that can be a very good entry. So I think this is one reason why I think the market is this is why I think the market is maybe a little bit more vulnerable than a lot of people think. The overall stock market is this particular pattern in the Russell right now. Here is a nice pullback that's worked in the yen. And I know we've been talking about these patterns for a while, but as I wrote on the slide that we didn't really talk about here, we are in an environment where we're seeing things work rather than seeing things set up. Do notice the little nested pullback here, and notice that our trailing stop methodology would have certainly worked very well to keep you in that trade. Another example here, 10-year treasuries. Look, complex bear flag. I didn't say bull flag with the Russell. I feel like I might have said that once. I meant bear. Little nested flag here. Nice short entry in the 10-year notes. Also 30s, 5s, Euro bonds. Everything's trading that way. Here's a high and tight pullback in FANG. And your initial stop, I would put probably a little bit further away for a pattern like that. So this is a trade that might be ready to happen. So one of the things that we do want to be careful of, look at this chart. This is a mess. And we saw this in a bunch of retail stocks where we had these giant collapses and then big moves back. This is very, very unusual. You can look at a lot of market action for many years before you see this. Now, let's not focus on why it happened. There's always an explanation why. But this is such weird price action where, even though this looks like a buyable pullback, I'm going to be really careful with these. I'm going to skip a lot of these. So if you look at retail stocks, you're going to see similar patterns. But this is one that I think might be tradable, and it's probably worth this little bit of homework. Maybe go through and look at some of those liquid retail stocks and see why we think that this is potentially a tradable pullback. So folks, thank you for your time and focus today. A lot of good information here. We will see you back for one more session where we're going to do some wrap up, and we'll slip a few more goodies into there, and we'll see you back Thursday. Thank you.